welcome to Growth and Value Stocks. My name is James Boyd. We've got Connie Hill in the chat. We welcome everyone here today as the two redheads talk about the market maybe going higher. Could this be a breakout party? Let's talk about it. Today's date is yours truly. Okay. Tax day. Oh my gosh. Why are we laughing? Okay. Anyway, probably some of you said April 15th. That kind of sounds like a day that some people dread. Anyway, a little fun there, maybe. I want to give a quick reminder that with this webcast is being broadcast via YouTube. You went to youtube.com, typed in Trader Talks Schwab Coaching Webcast. These are live sessions, but they're also recorded as well. As you go to that page, you can also subscribe. That way you can see other content. We break down our content by playlist or shorts or videos, and you could even find certain videos just by subscribing and searching. It's free. Just do it. Now, just real quick as we get started, remember that Connie Hill is on X. You can see her at Connie Hill CS for Charles Schwab right there. And she posts educational content there daily. Myself, I post content and some amusing stuff throughout the day or the week also there as well. So follow us there. Now, just real quick as we get started, one thing is to kind of remember, this is a stock class. So that does not mean that some of the things we talk about can't be just maybe some other type of product, but this is really growth and value stocks. So we'll talk about stocks, okay? Now also remember when we talk about examples, the information I talk about is done for general informational purposes only. Schwab does not recommend the use of technical analysis as a sole means of research. Even if you were unbelievable technical analysis, you still want to have an idea, okay, of what you're actually buying. I think of technical analysis as the outside. But if you're getting married or starting a business, you want to kind of look at the numbers, okay? And that's really the fundamental analysis. Now, when we talk about examples, we'll do those on the paperMoney software application. When we talk about, let's say, stocks that pay dividends, we know that those dividend-paying stocks, they may reduce, they may stop paying dividends, they may increase dividends, okay? Moral of the story is the dividends are not constant. They can change. When we talk about examples, investing involves risk, including loss of principal. We know that if we want to try to have a reward, we need to actually understand that there's risk with that. Without taking risk, there is no reward, okay? And so that's why the investor is always monitoring what the risks are, how much is the risk, and are they willing to take that risk? And all of us are a little different in that section. Now, also remember when we talk about examples, we'll talk about growth and value and income styles. Today, we're going to talk about a little bit more about growth because that's where we've really seen the explosion. Now, we'll talk about some stocks from a technical and fundamental point of view. And my goal here today is kind of really talk about some stocks that have breached support but are reversing sharply. Speaking of sharply, one of the areas that I want to go to just real quick is I want to pull up just real quick the SPX. Now, I made a comment yesterday. We talked about kind of the symmetry, okay, of when you get stocks that go down or an index or a sector, or an industry group, and then on the right-hand side, you look and see how quickly it went back to the upside. We made a comment yesterday, which I'll repeat, that when you go up faster than what you went down in terms of days, duration of time, the faster you go back up to the previous high, the greater the chances you have to be in a continuation pattern. We call this pattern, or if we said what letter of the alphabet do we have here, it looks like a V, okay? And on the right-hand side of this V, the faster we go up, so where's the pivot? Where do we stop going down? It was March 30th. Where do we start going up? Where did the crossover happen? It was on the date of April 1st, April Fool's Day. That's if you're a bear investor in total. Now, that does not mean you can't have a bearish position, but more of the story is we don't have, I can't think of the last time in the paperMoney accounts we've ever had a bearish portfolio. It's been years, okay? This is why we talk about having a portfolio that is more bullish than bearish. On April 1st, had the crossover, and since then, the technical indicators have been showing more of a bullish reversal.
When we look at this on a weekly chart, which let me say one more thing here. When you look at this, the reason why we're calling this maybe a potential breakout party, the highest that we ever have been on the S&P 500. By the way, I remember when it was like 500. By the way, if in 1980, can anyone tell me where the S&P 500 was in 1980? Now, this is probably going to make us sick, but someone tell me, where was the S&P in 1980? Okay, a little history lesson there. Now, the high we actually had on the S&P was 7,002. Where was the high today? Answer. The high today was 69.95. So we're 7 points off that high. Now, where does the paper money account think this market's going? Higher. Okay. Now, when we take a look at this, if we kind of just said, look, basic symmetry from resistance down to support, that kind of the movement there from top to bottom, low to high, that's 650 points. 650 points on that price, on those price levels, is 10%. When we forecast in time, we're not just going to say 10% because, well, you got to remember, as we go up, the percentages aren't going to be the same. The point move, we're going to use that though. So if we kind of said, well, look, if this market broke to the upside, let's say we go out into the year end, if it did go up, probably would think it wouldn't be surprising to get to 76.50. Okay. Now, you look at this on the weekly chart just real quick before we look at our examples. This is what it looks like. This old breakout here was at 61.33. We never got there. And if you look at that on a weekly chart, hello, weekly, paying attention, just making sure. We don't want to say, I didn't see it coming. The biggest thing is, now remember, there's been 2 weeks here from April 1st from the crossover on the daily. Here we are on the 15th, now starting to see that weekly crossover. I want you to remember this comment I'm about ready to say right here. All we've done is on the S&P chart, we've just established the pull. We have not had a pullback yet. So we've just made the pull. If you make a pull price ascension, you have the highest likelihood of making a higher low, called a flag. I posted on X something talking about statistical, when you make highs, what's likelihoods of making higher lows? And I posted that, retweeted that on X. If you didn't see that, go there and look at it. Okay. So that's what we're kind of thinking, that this move might just be getting started. Now, I'm just going to fast forward just real quick. When you look at the NASDAQ, I mean, does that look bearish? 40,466 should have been resistance. It didn't hold. We smashed our way to 25,757. And these are not small candles here like bullish haramis, spinning tops. These are candles that are the size of the Eiffel Towers here, and they're contesting these old highs. We only had 2 closing highs. If we close here, this would be the highest close we've ever had. Hallelujah. Okay. And look, this is why people, when things go down, they do dollar cost averaging. And I think that's been mispracticed, or not practiced probably enough. Don't worry, we're going to get a little practice here today. Now, the Russell 2000, just quickly. The Russell 2000, if we take a look at this, if we close here, remember, this is only Wednesday. We got to get to Friday, okay? So we got 2 more days here. If we close here for the Russell 2000, okay, little breakout party here, okay? This would be the highest close the Russell has ever had, okay? Very strong movement here. And again, I think a lot of people, they're kind of thinking about the news. You got to remember, investors invest for the present and the future. Okay? It's not what's just been happening in the past. Okay? So remember, when you look at the VIX right there, kind of sliding to the downside, and that's what those bullish investors like to see. VIX high and falling. That way there might be some runway room for a bullish trend. Be very careful of who you listen to. I'm telling you, I hear some of the stuff just out there in the general, and they're like, I can't trust the market. We don't know for sure. You never know for sure. People just kind of make some comments that it's just awkward. And it makes me think, are they really technicians, or are they trading their feelings? And it's mostly the latter a lot of times. The technicals are showing something different than emotion right now. And remember what we always say, investing is math and psychology, okay? Now, if we take a look at this, I want to kind of go to a couple stocks. And if you don't mind, I want to kind of start with, now, feel free, I can't pull this up, but I want you to look at gold, I want you to look at silver, and I want you to look at copper. In our first example here today, I'd like to kind of take a look at two different stocks. First stock that we'll actually take a look at is FCX, and the second stock we'll actually take a look at is AEM, okay? Now, if you look at, let's say, the three prices, gold, silver, copper. You should know that. But if you watch any class IT, you know those are, we look at those all the time. Now, here's the deal. We know there's earnings coming up. We get it, okay? Now, the biggest, by the way, most stocks have earnings coming up. Now, if you look at this chart, this is your classic V pattern. Now, when I pull up AEM, just so we can see the charts technically, this is what it looks like, okay? Kind of has like a little area of resistance. It has not gone up as much as FCX. Now, AEM's twin cousin is NEM, and you're going to kind of see that that's pulling back some. Could that be a flag? Yeah, it could be. But I want to compare and contrast FCX and AEM. And I want to do it from a fundamental standpoint. Now, let's go to just real quick, the Schwab.com. And what we're going to do is we're going to type in, let's go look at FCX first, okay? Now, if we go look at FCX, I want to kind of show you some of the tools here, and then we're going to come to an investing example. Now, if you look at FCX, here we go. We're on Schwab.com. What we're going to do is we're going to scroll down. Got the chart, got the news. Some has more news than others. Dividend over the last 4 quarters has been flat. Okay, so someone that says I'm an income trader, probably not doing it for dividend, as that dividend nominal very low, and you look at the yield on a percentage basis, not even 1%. Probably not doing that for a dividend. Earnings. The upcoming earnings, and this is the major point in showing this. If you're buying stocks, what are the upcoming earnings? Well, I don't know. Then why are you investing in it? Okay? If you're buying a stock, you're thinking that that stock is showing some sense of what they think the upcoming earnings is going to be, good or bad. When you look at actually FCX, Q1 of 26, 46, 62, 91, 97 cents. Q4 over Q1, that's a pretty big jump, okay? Now, if we take a look at this, we go to the historical, darker blue estimate, lighter blue actual. It's not a bad thing to see that those numbers actual are greater than estimate, meaning they're not managing completely the earnings, okay, and barely squeaking out the estimate, kind of sometimes beating it by quite a bit percentage-wise. Now, when you also look at, let's say, the forward PE, that forward PE, which is the current price divided over the expected earnings per share over the next year, it's only 23. Now, if we're talking about growth stock, that's really not that high. And that PEG ratio, looking at the price over the earnings per share percent over the next year, it's only 1.63. Now, the one thing we want to kind of say right here is when we take a look at this, some companies, and we did this last week with looking at one company, and we noted on the right-hand side that Marvel, MRVL, was one that was kind of stood out on the table. Well, the one that we might take a look at is if we're talking about investors invest for the present and the future, it's really also, if you look at this, the FCX, if we're talking about overview, 27%, and you look at Barrick, which is 57%. That's pretty high. You look at net profit margin, okay, the net profit divided by in the sales, 16%. You're seeing that Barrick, by the way, what's the ticker symbol for Barrick? And it's going to be right there, B. We'll look at that in just a moment. Net profit margin, 42. The reason why you want to do this is sometimes the stock that you're initially looking at might not be the only one, just like in real estate, okay? You might find a certain house that you like, but then realize that another one that might be better is maybe more attractive and you like it better. Now, if we take a look at this, let's go to this chart just real quick and let's look at FCX. Now, sometimes when the price is high, we actually think, oh no, that's horrible. Now, I want you to start thinking about dollar cost averaging, okay? If the investors say, look, I'm going to buy some here. Now, sometimes when the price is high, people don't like to buy at a high, okay? If we look now, I kind of joke and say, well, when you met your spouse, did you meet him at a low? Did you meet him in the middle? Did you meet him at the low? Most people say, well, I met him kind of at the mid-range to maybe the top, okay, at that point in time. So just because something is high doesn't necessarily kind of push us back. We might be saying, well, it's at a high for a reason. Maybe it could go higher, okay? Maybe that's why it's at a high. Now, if you look at this, when is the earnings? The earnings is on 4/23, so it's next Thursday. Now, if we said dollar cost averaging, let's imagine that we try to buy in thirds. If we did a position size of $10,000, well, a third of 10,000 would be 3,300-ish. 33, 33, 33. 33, 33. $3,333. Now, you don't have to. Let's say we did half. 5,000, 5,000, we get to 10,000. What I'm going to do is if we said, where would the investor try to buy it? Well, they might try to buy some here. Second is if the stock actually broke out. Many investors might say, no, I'd like to actually get in if it pulled back some. Well, let's split it, okay? So let's imagine the investor says, look, I'm going to try to buy some here. Buy custom with OCO bracket. Okay, let me actually go back to the big money count. And what I'm going to do is I'm going to try to establish a position, okay? So when I look at the FCX, I'm going to try to buy some at the current level. Now, I'm going to right-click on this chart, buy custom, and then go with OCO bracket. Now, when you look at FCX, you should be thinking, what do they sell? What is the stock price correlated to? Is it correlated to gold? Is it correlated to silver? You could overlay gold to the price chart of the FCX or silver or copper and see what is it correlated to. And then watch that price of gold, of silver, of copper, and so on, and know that that might have a downstream effect on the stock price. Now, we're going to do some dollar cost averaging. What I'm going to do in this case is I'm going to try to buy some shares. So number one here is if we actually decided, hey, I'm going to actually do a dollar amount, I'm going to click on that icon until we go to the dollar amount, okay? I'm going to type in 3,300. Now, we could do this in a couple ways. If I did 33.33, $3,333, this is a third of the total position. How many shares would it get us? Well, we do that. It's going to be about 48 shares. Do not laugh of actually thinking that, oh, if we buy a lower dollar amount of shares, it can't turn into anything, because that's not true, okay? If you look at the example, we had an example recently where we bought 7 shares and went up $700, okay, recently on an example we did. So it can go up and down, even though we have a small amount of shares. What I'm going to do on this is I'm going to buy $3,300 worth of stock, which is 48 shares, and we're going to put a date of GTC. Now, when we look at these V patterns, and if you're not aware of V patterns, probably want to be aware of it. We have a trough of that V right around 52. The resistance on this is right around 68. Now, do we know it's going to go up that amount? You might know. We don't know. I'm going to put a target here. If we did that, that's about $16. Let's measure, okay? So if you say I'm not good at kind of remembering the numbers, well, let's just measure, okay? That's $16. That's where I got that. If we added 16 to 68, that's going to be about $84. And if we put $84 as far as the target. Now, a lot of times when people are brand new, they set tight stops, only to find out that setting tight stops gets you out or tends to hit you out before maybe that move is even done. The one thing we want to be very mindful of on FCX is looking at the 58 and the top end, let's say 65. So if you set a stop any higher than 65, you're not even allowing the stock to pull back down to support. Very careful of that, okay? I think sometimes we set stops too tight and we're not allowing the trend to trend. And then we make comments like, well, I can't get anything to trend. Well, it's because you're choking the stops, okay? So we wouldn't want to set any stops. In our example, I'm not going to set any stop tighter than 61 and 61.40, okay? Why? Well, because we're going to try to buy more. If that price dips, we're going to try to buy some more. Okay. So anything higher now, this breakout level, that's where it broke out from. Do we know that support? We don't know that yet. Where's the second breakout level? It's right around 61.50. So we're going to try to set the stop at 61.40. Okay. And we're going to set it less 2%. We're going to set a stop at 61.17. Now, there's two ways you could actually do this. Okay. Number one, we could have our second order right at this 62-ish level. That's the first area that someone might set that. What we're going to do is we're going to set an alert. Remember how this works. If it goes to that price or less, it triggers the sell. Okay, fine. We understand that. That stop is a market order. To trigger to sell at that price or less, send it. And it's sitting right there. We can see that. Now, I'm going to right click on the chart at the first level of what we think is going to be support. Well, that first level support is about $65. So if we get at or below that level, I'm going to write the point of add more question mark. Okay. The second is if this stock actually gaps down to the second level of support, okay, create an alert, add more, at or below, create. So what we're going to try to do is if we come down to this first level of support, I'm going to try to add to the position, trying to buy in the pullback. If we get something on earnings where it gaps down to the midpoint of the channel, many people say, well, that's what I'm trying to really add because that's where this first breakout really happened. I mean, if we're talking about a little higher, the major basing pattern reversal was down around $58. Okay. Now that could be even the third level, but I think you get the point. Okay. So the first major theme I want to kind of talk about is something that has broke out, trying to add to the position at the first or second support levels while not having a stop that is so blasted tight. Now, how could you find something that maybe is just starting to break out? All right, now, on a daily basis, we always try to actually find breakouts. So what we're going to do is, let's imagine we don't have a list, that we're physically going through the list. Now, when I say physically, we're not sweating here, okay? We're not like digging a ditch with a shovel and, oh my gosh, it's so hard. What I'm going to do is I'm going to go to the second chart in. The second chart in really shows us the price, the moving averages, and 3 breakout lines on a daily basis. What I'm going to do is on this Dow Jones, I'm going to click on the first stock. Now, when I click on that first stock, the lines that are dotted, those are the breakout lines in terms of duration of time. The orange line dotted represents a 10-day high. That's the shortest duration we look at in terms of breakouts. The blue line is a 20-day high. Now, could this be there are some investors who were bearish that are starting to reverse their position? Yes. It wouldn't take an advanced investor in the market to understand that most of the stocks that have been going down, they're starting to reverse in the software space. Okay. Intuit, Microsoft, Oracle, I said Intuit, and even stocks like Nike and so on. Some of those stocks that have been beaten, battered, and bruised, starting to show some reversals. Let's say the investor says, I want to kind of see something that's showing a little bit more of a trend. We cannot say that Nike has been an uptrend, so we're going to disregard that. We go to the next one, Salesforce, same thing. It's also been something that's been in a downtrend, not even actually hitting the breakout line. We go to the next one and say, we look at IBM. Is that even hitting a breakout line? It's not. We go to the next chart, doink. We actually look at, is NVIDIA hitting the 10-day high? It actually hit the 10-day high on the 8th. Then it hit the blue line on the 10th. And then it hit that line, the 55-day high, the silver line again. Why do I like these lines? Well, because what I found in almost 30 years of doing this is you would say to someone, it's breaking out, and they would say, well, not really sure. And like, well, it depends. The answer to the is it breaking out is dependent upon someone drawing a line, okay, which can vary based upon how they draw the line. Me? It's simple. I draw the line horizontal or diagonal where we get the most touches, irregardless of how I feel. Sometimes people are different, okay? You're not going to see me draw lines different. Whether it's horizontal or diagonal, where we get the most touches, irregardless of what I think, that's the line that wins. If I took that away and said breakout being orange 10-day, blue line being 20-day high, gray line being 55-day high, the NVIDIA example is smashing to the upside. It's irregardless of actually what we think. There. Now, the purpose of the orange line is think of that as a short-term trader, swing trader, momentum trader. Think of the blue line as kind of more intermediate, and think of the gray line as intermediate to longer term. Okay? When I say orange, what do you mean by that? 2 to 3 days to 2 to 3 weeks. When you say the blue line, what do you mean? 2 to 3 weeks or 2 to 3 months. When I say gray line, 2 to 3 months to 2 to 3 quarters. Okay? So it's just spanning out of time. No wonder if you're hitting all of them. You got short-term traders, intermediate to long-term traders, maybe all trying to ride that trend. Okay. Now, if we take a look at this, okay, if we look at this, let's go to that second chart back and ask ourselves the question, is it too high? Well, if we're talking about an entry, and we've hit this a number of times, it's not brand new, okay? And again, this is what I like. When I hear someone teaching, whether there's a methodology wrapped with it numbers, oh my gosh, okay? Now I'm getting a sense maybe the person has experience. If we take a look at this, the 10 exponential is the light blue line. The yellow line, if the investor was saying, look, I try to get in close to support, they're trying to get in between these lines. We call that an A entry. Okay, like, wow, that was probably about as good as you can get. Okay, now if we got in, let's say all of a sudden from there to there, we would label this as a B entry. Okay, we're not as close as support really being the 10-period moving average most of the time. Okay, if we look at this and say, look, now we're getting in, let's say the white line from the 10-period moving average to the white line, it is kind of more of a C entry, meaning that we're having to take a little bit more risk, that if this pulled back, that we would have to endure more of a pullback to see if the stock is going to do what? Bounce and make a higher low. Okay, so that's how we do it. Now, these lines are based on percentages. Yellow line, 3% above the 10-day moving average. Red line, 5% above the 10-day moving average. White line, 7% above the 10-day moving average. Dark blue line, 10% above the 10-day moving average. Now, we don't talk about buying stocks above the white line. So if we're talking about buying something here, what the investors say, look, I'm going to go all in. Well, you go all in here, you're going to probably feel all going down. And this is where some people might say, look, I want to leave some capital that if I were to pull back down to here, do I have some capital to buy the dip? Okay. Now, if we take a look at this, what I'm going to do in this case, and I'm doing different examples for different reasons, I'm going to bring this up and say, look, I'm going to try to buy on this little upside move, right click on the chart. And what I'm going to do is I'm going to right click on the chart at the current price level. Okay. Buy custom with OCO bracket. Now let's do it faster. We don't have to explain it every time. Okay. So remember, let's say we said, hey, $10,000 is normally how much I'm investing. Well, I'm going to split it 33. Okay. How many shares is that? 16. Now, what about a stop? Well, we're not going to set a stop any higher than that 187.29. I'm going to take the initial stop 187.29. The nice thing about splitting the entries is if you let it fall back from 199 down to 187, you're not falling down in the whole entire position. Do you get that? So you can set a looser stop and it doesn't matter as much. Type in the chat if you get that. Okay? Now, if you wake up tonight sweating, sitting up in bed, your wife says, "What's wrong?" Or your husband says, "What's wrong?" I get it. The first entry, I don't have to set tight stops. I just start with a smaller position. 183.54. 183.54. Okay? Dated GTC, dated GTC. Now we got the stop, but what about the target? Calling all technicians. Well, if we take a look at this and say, where might it try to go to if it can? Well, the only prior high we had above us was 207. Might make more sense to go to the weekly chart. Now, I'm going to tell you, I don't care if you're a short-term type of trader, intraday, daily, weekly. If you're not looking at the weekly charts, it's a mistake, okay? Because you're not really seeing the bigger picture of what's happening. When you look at this, you might even ask the question, have we been in the process of really making like a longer-term flag? And when you look at these over weeks, and you could draw this different ways, I'm not sure if we're going to get completely different numbers. 208 is really the prior high. If we could even kind of draw this and say even lower, most of the touches came right around the area, let's say 193-ish. If I took 193-ish and kind of did the same thing where we got most of the touches, most of those touches, okay, if I drew this and kind of put that extension is right around 256. Now, why do we bring this up in terms of NVIDIA? Well, most of these semiconductors, some of these chip names, some of these stocks also got pushed down or they paused for a while. Okay. Now, if we typed in NVIDIA and said, what does NVIDIA have? Okay. Now, if we pull this back up, NVIDIA, scroll down, let's see what we got. Let's go dividends. Don't pay any dividends. You don't see that or very little growth. Okay. They're not sharing that, the earnings with the investors. They're trying to give them the growth, trying to get the equity to grow. 176 and 246. It's about 70 cents. 70 cents on 176. That's about 40% from Q1 to Q4. Historical earnings estimate to actual, little stair step. Okay. And again, some investors really like to see that when they actually have good earnings, they're not just matching what the estimate was. They're not guiding the earnings to say, so to say. When you look at the 4P, it's only 23. Okay. Now, you said last week, when you look at the PE, trailing earnings, it's at 40. But why do some people buy the stock when actually the PE is like that? Well, it's because where they think the earnings is going to go. That forward PE is typically lower. Why? Because the estimate of future earnings is higher, okay? Which causes that multiple to drop. That price earnings growth, PEG ratio, okay? You only got 102. Literally, a PEG ratio of 102 is like what you would see a utility stock or a staple stock, for crying out loud, okay? Now, we pull this back up. Now, I am not going to put 256. Now, don't make fun of me, okay? I'm going to even put a slope coefficient of, let's say, 230-ish, okay? I'm going to add that slope coefficient curve to 230. What is that going to do? It's going to get us like a line that's really in the middle. Now, what that's really doing is I'm kind of like saying, look, maybe I don't think that it could go to that level. And if it does that, what it's really going to do, and I really want to type in 1.30, excuse me on that. Let me right click. So it was right. I just need to put 1, okay? And there it is. What that's going to do is it's going to put that line in the middle, okay? We know that if we set higher targets, lesser probability of going there. Some people would rather have like a win maybe that has a greater chance, not 100, okay? We're going to put 223.25. Now, if you look at that semiconductor space, that's not the only stock that has been pushing to the upside. Give me some of those semiconductor stocks that have been pushing to the upside. Now, number one is we're trying to buy the push up in price. Now, here's what I got to ask you. This is what I'm trying to download into your mind today. Where would you try to get in if it pulled back or it went higher. Where? Type in the chat. Now I'm going to go back to the daily time frame on this. If you saw this stock pull back or go up, where would you try to add to the position? Where? Now, here's the thing. If you never ask yourself that question when it pulls back, you're probably going to miss it. How do I know that? Because that's what I did. Okay. You got to always be thinking, this is like chess with checkers. You don't want to think about that one move you're doing. You want to think, if I do this move, what's the next move? Think in twos. Okay. So if we actually said, hey, if we pull back, if we just made a high, the highest likelihood is a higher low. Well, where might that try to be? The higher low might be at the old resistance areas. Well, where is that? Well, it's right around 192. Now, do we put it right at 192? Or do we put it in the area of 192? We put it in the area. When you say area, within 1 or 2%. I'm going to right click there. We had to pull out the perfect ruler and like perfectly. No, just look, eyeball it. What's 1% of 192? $1.92. So if I put this right around about 193 and change, it's going to we're going to set the alert. The alert is not an entry. It's an alert. It's like an alarm clock. Okay. Well, we're not saying at or above. We're saying at or below. And I'm going to kind of go back to add more question mark. So we know that we made a high. If it pulls back, red candle. The red candles tend to be the opportunity. As long as the red candle is above the moving averages, bulls want to hug those red candles because those red candles push the price back down closer to potential support. Red candles are not your enemy. They're your friends if the price is above the moving average. Okay? Now, if the price of the stock gets at or below that price, let us know. The investor might actually evaluate that and say, can I start to seek hold entries or close above the high and the low days? Those are bounce setups. Okay? Now, the other stock I want to go to just real quick. So remember, don't think of just one entry. Think in terms of like you're getting in waves. I'm buying the bounce and the breakout. Or I'm buying the breakout and I'm buying the bounce. Adding on the bounce. Okay, let me repeat what I just said. Buying the breakout and then trying to add if it actually pulls back and bounces. Or I'm buying the bounce and then adding in the breakout. You're not putting all the capital in at once. Okay. Now, if we look at, let's say, the second stock, let's go back and kind of do that breakout. Let's go to that second chart. The next stock in that list was Apple. Now, if I ask 300, 400 people, where do you see the breakout line? You're going to get all types of different answers typically. Okay. Here's what I like about just looking at durations of time. It doesn't matter what I think or someone else thinks. It's just what it is. Okay. Now, if we look at this, what's the orange line right there? Well, that's the 10-day high. What's the blue line? It's the 20-day high. What started to happen on Apple here about on April 6th? It actually hit the 10-day high, maybe even hit the 20-day high. I'll zoom in so we can see that. What happens if the orange and the blue line are overlaid on top of each other? Well, that in that case is just that it's hitting this current stock price is hitting a 10-day high and a 20-day high at the same time. Is that a bad thing? No. Might be getting in some of those short-term traders, 2-3 days to 2-3 weeks. It could also be getting in some of those traders 2-3 weeks to 2-3 months. Now, if we're talking about trading breakouts, we're actually seeing a breakout on the chart. It's not up to someone's discretion. Okay. Now, the other thing we could see that's also not up to someone's discretion, but we want to verify because scripts are not guaranteed for they're not guaranteed for accuracy or timeliness. We want to verify with our own eyes. We want to understand what the script is showing, trying to show, and verify it. Now, the other thing we see on the chart is those green dots. What are the green dots? Well, that's close above the high of the low day. What are the most recent red candles? There. Which one is the lowest? Second question. Right there. Third, are we trading or closing above that high? Answer, Yes, that's why there's a green dot there. Now, number one, I'm going to right click on that chart, buy custom. Now, here's the thing is, when you kind of make it to where you have to kind of just say yes or no, it takes away a lot of that confusion. Once you take, then you ask the questions, all of a sudden you're trading a system, a methodology. Okay, now, if I go and buy custom with the OCO bracket, we're going to put the target on it. Okay, now, just like we did before. Now, what if you said, well, James, I don't want to buy third. I want to kind of do half. Okay, fine. If I did that, if I said, look, 5,000, click on the pool balls, percent, dollar, I'm going to add 10 to that. How many shares is this? About 19 shares. What I'm going to do is wonder if the stock breaks to the upside. Well, I'm going to still have that alert, okay? But what I'm going to do here is I'm going to actually just kind of, I want to kind of throw something else, a situation that might happen, okay? Now, we're buying some shares here. We're going to put a target. If we looked at this chart and said, where was those old highs? Most of those highs came in right at 276. So I'm going to go ahead and put that target right at 276 and change the dated GTC right there. Where is the support? Well, the support, if we drew a line, is probably right underneath that trend line, that open of today's candle, which is 258 being the support area. If I took 258 less 2%, it's going to be 252.84. 252.84. Okay, confirm send. Now, I want to talk about a situation that might happen, just real quick. What happens if you get a stock where it runs to the upside? You said, look, I like to try to add a position if it pulls back. Okay, what's the reality? Well, the reality is sometimes the truth is, James, I like to buy if we went back maybe to the midsection of the candle, but sometimes it doesn't do that. How many of you have seen that same thing where you said, James, I would like to buy more if it fell down, and you had your order there, but it doesn't come down exactly to where you wanted it to be? We've all been there. It's the worst thing ever. Now, if we see the next 2 days like this and like this, and you say, look, I want to get in more here, you might have an at or below, but you have to understand something. If you get that pullback, you might say buy if it gets at or below a certain price, or buy if it goes at or above. And that last piece is what people don't typically like to do. They're always trying to buy if it falls down. But on this order type, you can say, look, market, click on the gear, and you could say, look, if it falls down to 260, 89, which is what we've been doing, try to get it in. I think that's where people would tend to be more comfortable, right? Now, but this line that I'm putting on, mark at or equal to, I'm going to think of this as almost like a trigger to get in if we get at or above the high of the lowest most recent red candle. And let's say that number was 264. So this is saying, look, if we get in, if we could get in, if we pull back to where I want to get in, fine, there it is. But if it doesn't pull back, what people forget is, what if it doesn't pull back? Wonder if it keeps squirting to the upside and it makes those investors chase it. Oh, how many times have you missed the moves? This is why we're hitting this. Well, now we're saying, look, if we don't pull back to what I thought, I want to kind of leave the door open to add to the position if we start trading above, closing above the high of the low day. Now, if we had those two red candles, we could see what is the lowest, most recent red candle, number one. Two, what's the high of that day? Three, how high you want to wait to see if it can get above that to get in. And whatever price you state, that's what we're typing in. So it's saying get in at this price or lower, there, or this price or higher. I'm telling you right now, we need to cover this, because if this market breaks to the upside, there's probably going to be a lot of stocks where you're going to say, look, I was waiting by the pullback, but you need to understand the market condition. So today's topic, dollar cost averaging. it's been so far it's been a mistake not to really be good at that, as we've seen the market crash higher. However, we're hitting that again. And we're also kind of bringing up these practices of entering these dollar cost average different examples. I want you to go out and practice that for homework. There's many examples to practice on, okay? And as you practice it, you're going to get better and better. Now, I'm out of my time here today. We've got the next session coming up right at the top of the hour. I want to thank Connie for answering the questions in chat. If you have not subscribed to the Trader Talk channel, what are you waiting for? Do it. Smash the subscribe. That you got to keep in contact with all the different content that we're live streaming and also posted on there as well. Remember, with what we talked about, investing involves risk. Without that risk, there wouldn't be a reward. So that kind of goes hand in hand. And remember that today's session was focusing a little bit more on growth stocks, which is not a bad thing. Go out and practice the dollar cost averaging. I know we will. And we'll continue to do that throughout the week as well. So with that said, stay tuned for our next webcast coming up right at the top of the hour. And thanks to Connie as well. Thanks so much. Take care. Bye-bye.